Alright, this course is a full guide on how to trade options from start to finish. I will teach you step by step everything about option trading, from how to deposit money, how to open your first trade, what indicators to use, what chart patterns. I will give you some strategies that will help you to make some profit. So this course is totally for free. But if you want to learn my advanced trading strategy that I use to make thousands of dollars of profit, I invite you to go to our website binarystrategycourse.com. Enroll that course. In that course, I will share with you everything about my trading strategy. Now, in this course, I'm going to use IQ Option as the platform where I open my trades. Option trading can be done on different platforms like Pocket Option, Binary.com, Codex, IQ Option, and many more. For this part, I'm not sponsored by any of these, and I leave you the decision on choosing your favorite platform. Now, let's start with what is binary option trading. When you are trading binary options, you are basically predicting the direction of the market, whether the price is going up or down compared to the opening price. The opening price is the price of the market at the exact moment you clicked higher or lower. A higher position, also called a buy or a call, is basically you are saying that the market is going up, and if really the market went up and the price is closing higher than the opening price, this will result in a profit. A lower position, also called a sell or a put option, is basically you saying that the market will close below the opening price, and if really this is the case, this will result in a profit. For example, here in one of my trading sessions, using some indicators and some chart patterns, my own strategy told me that the market is going down the next minute. What I did is that I invested this amount of money, I clicked lower, waited 1 minute, and really, by the end of the expiration time, the market went down and I made this amount of profit. But in the other hand, if my prediction was wrong, for example, if I opened a high position predicting that the market is going up for the next minute and somehow the market went down and closed below the opening price, I will lose my investment. And the same thing with the lower position. If I open the sell position predicting that the market is going down the next minute, but somehow the market closed above the opening price, I will lose my investment. You can choose the amount of your investment here. Me personally, I like to trade with $500 or less, but that's enough for me because if my prediction is right and I want to trade, I would make over $400, and I can do this for every 1 minute. For example, me personally, my strategy generates me signals with 8 minute up to 12 minute long, meaning that I can make something from 8 to 12 wins in 1 day. That's multiplied, for example, with $400, so that's around $4,000 per day. But if you are a beginner and you don't have a good strategy, I advise you to start small with $10, $20, $50 at maximum. And this is why I always say that option trading is a good opportunity to make money fast. But please, if you are a beginner, keep in your mind that it's so risky. That's why you need to start with demo accounts. You need to keep training. You need to master indicators, chart patterns, and especially you need a good strategy with a good money management method. In my course, I present that type of training, but please remember that I'm not in any way telling you that you need to buy my course. You can develop your own strategy, you can read books, free YouTube videos. It doesn't matter where you learn. What matters is that you need to master a good strategy that you trust and that you are sure that it will give you good results without making you lose your money. Next, you can choose the expiration time here. My strategy works on the 1 minute expiration time, but you can have a strategy that works on the 5 minute, 10 minute, or 1 hour expiration time. The expiration time is shown on a chart by this red line. This white dotted line is the purchase deadline. Up to this time, you can buy multiple options of the same asset with a chosen direction. So before the purchase time reaches 0, choose the direction of the price movement. If you suppose that the price is going up, click higher. And if you suppose that the price is going down, click lower. After your transaction crosses the red line and expires, you will see your results. Either a green window with the amount of the profit you made if your prediction was right, or a red window with the amount you lost if your prediction was wrong. In binary options, it doesn't matter how significantly the price changes. So you can win or lose, and also there is a third result. If the closing price equal to the opening price, your initial investment will be returned to your account. How to deposit funds. To get to the deposit page, click on this deposit button in the home page in iqoption.com. You can also do that directly on the trade room by clicking on this deposit icon. The minimum deposit amount is $10. You can deposit US dollars, pounds sterling, or euros. If your account is in a different currency, the funds will be converted automatically. You can enter the deposit amount manually, or you can select from the list. There is multiple methods to deposit funds to your account. You can use Skrill, Neteller, Perfect Money, Visa or MasterCard, and also you can deposit money using Bitcoin. Choose one of these methods, enter the amount, accept the terms and conditions, and click on Proceed to Payments. You will be redirected to a new page, and here you will enter your credit/debit card informations. Once you finish entering the informations from your card, click on Proceed to Payment. With some payment methods, you will need to enter security code sent to your phone. Write the security code here and click Confirm. If your transaction has been completely successful, a confirmation window will appear and your funds will be credited to your account. Now, let's talk about digital options. Previously, we talked about binary options. This time, I'm going to talk about digital options trading. On the right-hand side, the chart is accompanied with several price levels. These are strike prices, or in other words, target levels that the closing price should go above or below for the position to close in the money. When choosing different strike prices, you can see here the profitability changing below the high and the lower buttons. It depends on whether the price movement can reach the set strike level with the chosen direction or not. But why is this? Because the odds that the market will go above this level, for example, are low. And if you somehow have a strategy that tells you that the market is going above this level, here the probability is very low. So if your prediction is right, the profit will be over 200%. So the lower the probability, the higher the profit. To be honest, the strategy that I teach on my private course is not the best when it comes to digital options. My strategy can help you predict the movement of the market for the next minute only. So it's useful when it comes to binary options trading, and also you can use it on forex trading. When trading options on this platform, you can see three numbers on the top of the chart. The first number is the total investment, meaning the amount of the investment you chose when you opened your trade. The second number is the expected profit. This means that how much money you will make at the end of this option or when the expiration time ends. If your prediction was right, the number will be shown in green, and if your prediction was wrong, the expected profit will be red and it will show you how much money you will lose. The third number is the profit after sell, meaning if you click the sell button right now, how much money you will make or you will lose depending on the number shown here. There is 4 types of charts available on IQ Option. The first one is the line chart. This one is the most simple one. Here, the market is represented with a simple line. Also, we have the candlestick chart. This one is the most important one and the one we are going to use in this course. Also, we have bar chart and Heikin-Ashi chart. For this course, we are going to focus on the Japanese candlestick chart. Alright, what are the Japanese candlesticks? In order to create a candlestick chart, you must have a data set that contains open, high, low, and close values for each time period you want to display. The red or the green portion of the candlestick is called the body, also called the real body. This long 10 lines above and below the body represent the high and the low range and are called shadows, or in other documents they call them wicks and tails. The high is marked by the top of the upper shadow and the low by the bottom of the lower shadow. If the market closes higher than its opening price, a green candle is drawn with the bottom of the body representing the opening price and the top of the body representing the closing price. And if the market closes lower than its opening price, a red candlestick is drawn with the top of the body representing the opening price and the bottom of the body representing the closing price. Compared to the traditional bar charts, the candlestick charts are visually appealing and easier to interpret. So, each candlestick provides a simple, visually appealing picture of price action, so a trader can instantly compare the relation between the open and close as well as the high and low. The relationship between the open and close is considered vital information and forms the essence of the candlesticks. Green candles, where the close is greater than the open indicates buying pressure. Red candles where the close is less than open indicate selling pressure. Long versus short bodies. Generally speaking, the longer the body is, the more intense the buying or selling pressure. Conversely, short candlesticks indicates little price movement and represent consolidation. Long green candlesticks show strong buying pressure. The longer the green candlestick is, the further the close is above the open. This indicates that prices advanced significantly from open to close and buyers were aggressive. While long green candlesticks are generally bullish, much depends on their position within the broader technical picture. After extended declines, long green candlesticks can mark a potential turning point or support level. So if buying gets too aggressive after a long advance, it can lead to excessive bullishness. And the opposite, long red candlesticks show strong selling pressure. The longer the red candlestick is, the further the close is below the open. This indicates that prices declined significantly from the open and sellers were aggressive. After a long advance, a long red candlestick can foreshadow a turning point or mark a future resistance level. After a long decline, a long red candlestick can indicate panic or capitulation. And with this, we have to mention the Marubozu brothers. The Marubozu candlesticks are a strong, long candlestick. Can be green and can be red. Marubozu don't have upper or lower shadows, and the high and low are represented by the open or the close. So, a green Marubozu forms when the open equals the low and the close equals the high. And when you see a green Marubozu candlestick, this indicates that buyers control the price action from the first trade to the last trade. And same thing about the red Marubozu candlestick. So, a red Marubozu candlestick forms when the open equals the high and the close equals the low. And this indicates that sellers control the price action from the first trade to the last one. Long versus short shadows. So the upper and the lower shadows on the candlesticks can provide valuable information about the trading session. This is why I always tell you to pay attention to the shape of the candlestick. So upper shadows represent the session high and lower shadows the session low. Candlesticks with short shadows indicate that most of the trading action was confined near the open and the close. Candlesticks with long shadows show that prices extended well past the open and close. So, candlesticks with a long upper shadow and short lower shadow indicates that buyers dominated during the session, bidding prices higher, but sellers ultimately forced prices down from their highs. This contrast of strong high and weak close resulted in a long upper shadow. Conversely, candlesticks with long lower shadows and short upper shadow indicate that the sellers dominated during the session and drove prices lower, but buyers later resurfaced to bid prices higher by the end of the session, and the strong close created a long lower shadow. Also, there is another type of candlesticks with long upper shadow and the long lower shadow and small real body that are called spinning tops. One long shadow represents a reversal of sorts, and spinning tops represent indecision. So the small real body, whether green or red, shows little movement from open to close, and the shadows indicates that both bulls and bears were active during the session. Even though the session opened and closed with little change, prices moved significantly higher and lower in the meantime. So neither buyers nor sellers could gain the upper hand, and the result was a standoff. So after a long green candlestick, a spinning top indicates weakness among the bulls and a potential change or interruption in trend. So the trend will change direction. And after a long decline or a long red candlestick, a spinning top indicates weakness among the bears and a potential change, so interruption in trend. Doji. In the world of technical analytics, doji represent an important type of candlestick, providing information both on their own and as component of a number of important patterns. Doji form when a market open and close are virtually equal. The length of the upper shadow and the lower shadow can vary, with the resulting candlestick looking like a cross, an inverted cross, or a plus sign. Alone, doji are neutral patterns. Any bullish or bearish bias is based on preceding price action and future confirmation. and the word doji refers to both the singular and plural form. So, ideally, but not necessarily, the open and close should be equal. While a doji with an equal open and close would be considered more robust, it is more important to capture the essence of the candlestick. The presence of a doji in a known period of time indicate the presence of an indecision or a war between buyers and sellers. Prices move above and below the opening level during the session, but the close will be equal to the opening level. So the result is a standoff, and neither bulls nor bears were able to gain control, so you need to be careful because a turning point could be developing soon. Doji and trend. The relevance of a doji depends on the preceding trend or preceding candlesticks. So after an advance or a long green candlestick, a doji signals that the buying pressure is starting to weaken. And after a decline or a long red candlestick, a doji signals that the selling pressure is starting to diminish. And yeah, a doji indicates that the forces of supply and demand are becoming more evenly matched and a change in trend may be near. So remember, doji alone are not enough to mark a reversal, and further confirmation may be warranted. After a long green candlestick, a doji signals that buying pressure may be diminishing and the uptrend could be nearing an end. So a market can decline simply from a lack of buyers, so continued buying pressure is required to sustain an uptrend. Therefore, a doji may be more significant after an uptrend or a long green candlestick. Even after the doji forms, further downside is required for bearish confirmation. This may come as a gap down, long red candlestick, or decline below the long green candlestick's open. After a long green candlestick and doji, traders should be on the alert of a potential evening doji star. And yeah, same thing. After a decline or a long red candlestick, a doji indicates that selling pressure may be diminishing and a downtrend could be nearing an end. Even though the bears are starting to lose control of the decline, further strength is required to confirm any reversal. So bullish confirmation could come from a gap up, a long green candlestick, or advance above the long red candlestick's open. So after a long red candlestick and doji, you should be prepared for a potential morning doji star. Long-legged doji. Long-legged doji have long upper and lower shadows that are almost equal in length. Those doji reflect a great amount of indecision in the market. Long-legged doji indicates that prices traded well above and below the session's opening level, but closed with a price virtually equal to the open. After a whole lot of yelling and screaming, the end result showed a very little change from the initial open. Dragonfly and Gravestone Doji. Dragonfly Doji forms when the open, high, and close are equal and the low creates a long lower shadow. The resulting candlesticks look like a T. Dragonfly Doji indicate that sellers dominated trading and drove prices lower during the session. But by the end of the sessions, buyers resurfaced and pushed prices back to the opening level and session high. So the reversal implication of a Dragonfly Doji depend on previous price action and future confirmation. And the long lower shadow provides evidence of buying pressure, but the low indicates that plenty of sellers are still appearing. So after a long downtrend or a long red candlestick or at support, a Dragonfly Doji could signal a potential bullish reversal or a dip. And after a long uptrend or a long green candlestick or at resistance, the long lower shadow could foreshadow a potential bearish reversal or a pump, and also a bearish or bullish confirmation is required for both situations. And the inverse of the Dragonfly Doji is called Gravestone Doji and form when the open, low, and close are equal and the high creates a long upper shadow, and the resulting candlestick looks like an upside down T. Gravestone Doji indicate that buyers dominated trading and drove prices higher during the session. However, by the end of the session, sellers resurfaced and pushed prices back to the opening level and the session low. And as with the Dragonfly Doji and other candlesticks, the reversal implication of the Gravestone Doji depend on previous price action and future confirmation. Even though the long upper shadow indicates a failed rally, the intraday high provides evidence of some buying pressure. So, after a long downtrend or a long red candle, or at support, focus turns to the evidence of buying pressure and a potential bullish reversal. And after a long uptrend, a long green candlestick, or at resistance, focus turns to the failed rally and a potential bearish reversal. So bearish and bullish confirmation is required for both situations. Support and resistance. So the market's price or the cryptocurrency's price is the result of a battle between the buyers and the sellers, or the bull and the bear. So we learned that the buyers push prices higher and the sellers push prices lower, and the direction prices actually move reveals who is winning the battle. Using this analogy, if you take a look here at the price of Bitcoin during this period of time, look, each time the price fell to $38,000, the buyers took control and prevented prices from falling further. That means that at the price of $38,000, buyers felt that investing in Bitcoin was worthwhile, and sellers were not willing to sell for less than $38,000. This type of price action is referred to as support, because buyers are supporting the price of $38,000. And the resistance level is similar to that, and it is the point at which sellers take control of prices and prevent them from raising higher. And if you take a look at the price of Bitcoin again, and in this period of time, you know that each time the price reached the $40,000 level, sellers were more than buyers and they prevented the price from raising above that level. So support levels indicate the price where the majority of investors believe that prices will move higher, and resistance levels indicates the price at which majority of investors feel prices will move lower. But there is something you need to keep in mind. Sometimes the investor's expectation will change with time. For example, in this case of Bitcoin, the resistance level was at around $40,000. And note how when prices rose above the resistance level, they did so decisively, and suddenly the breakout above the resistance level was accompanied with a significant increase in volume. So once investors accepted that Bitcoin could be traded above $40,000, more investors were willing to buy it at higher levels, causing both prices and volume to increase. And in the same time, sellers who would previously have sold it when prices were above $40,000 also began to expect price to move higher and were no longer willing to sell. Resistance becomes support. When a resistance level is successfully penetrated, that level becomes a support level. Same thing. When a support level is successfully penetrated, that level becomes a resistance level. Let's take this example, Bitcoin. As you can see here, there is a support level at around $48,000. And once this support level was broken here, this support level became a resistance level, and Bitcoin couldn't be traded above the $48,000. This is happening because a new generation of buyers who didn't buy when prices were less than $48,000 and they didn't have a bullish expectation then are now crazy to buy anytime prices return near to the $48,000 level. The three white soldiers. So the three white soldiers is simply three green candlesticks formed after a downtrend, and this indicates that soon a bullish reversal or an uptrend is coming. So this pattern is made of three long green candlesticks which don't have any shadow or sometimes have a small shadow. So each one of these three candlesticks opens within the real body of the previous candlestick in a pattern. So you as a trader, if you see a downtrend and after that you see this type of pattern, you see the three green candlesticks, then you can buy or long expecting an uptrend. Bullish engulfing. So the bullish engulfing or the candlestick engulfing is two candlesticks formed after a downtrend, indicating that an uptrend is coming soon. So this type of pattern will take place when a downtrend is happening and the red candle is formed. And after this red candle, we see a green candle appears. This second candlestick is a long bullish candle that completely engulfs the first candle and shows that the bulls are back in the market. What you can do as a trader is you can enter a long position or buy if the next day a green candlestick appears, and also if you trade in future, you can place a stop loss at the low of the second candle. Piercing pattern. The piercing pattern is an example of two candlesticks. The first one is a red candlestick and the second one is a green candlestick. If these two candlesticks are formed after a downtrend, this indicates a bullish reversal. So the first candlestick must be a red candlestick and the second one is a green, which opens gap down but closes more than 50% of the real body of the previous red candlestick. And this shows that the buyers are back in the market and a bullish reversal is going to take place. In this case, you can buy the crypto or enter a long position if the next day a bullish candle is formed, and you can place a stop loss at the low of the second candlestick. A hammer. The hammer is a unique candlestick pattern that forms at the end of a downtrend and signals a bullish reversal. The body of this candle is a little bit small and is situated at the top of a lower shadow. The length of this lower shadow is almost twice the actual body. This candlestick sometimes don't have an upper shadow, or sometimes it has a little upper shadow. The psychology of this candle is that the sellers pushed down the prices after the opening, and suddenly the buyers came back to the market and pushed the prices up and closed the trading session more than the opening price. And this signifies that more buyers are coming back, and if there is a downtrend, we are expecting that this downtrend is going to end and perhaps we will see an uptrend soon. So here, you can buy the crypto if the next day you will see a red candlestick, and also you can place a stop loss at the low of the hammer. And the inverse of that is called the hanging man. The hanging man is a single candlestick pattern which is formed at the end of an uptrend and signals a bearish reversal. So when you see this type of candlestick appears at the end of an uptrend, you should expect a downtrend and you can sell or short. 3 inside up. So after the downtrend, if you see 3 candlesticks, the first one is red, the second and the third are green, and those green candles, the first green candle must be in the range of the first red candle, and the second green candle should be a long bullish candlestick, a long green candlestick. And this confirmed to us that an uptrend is coming soon. So you as a trader, if you see this type of pattern, then you are expecting a reversal, and you can say that an uptrend is coming and you can long or you can buy the crypto or the option. Bullish harami. When a bullish harami forms after a downtrend, this confirms that a bullish reversal is coming. The bullish harami consists of 2 candlestick charts. The first candlestick being a tall red candle, and the second is a small green candle, which should be in the range of the first candlestick. So, if after a downtrend a bullish harami appears, this means that you can long and you can buy the crypto and you will wait for the uptrend, because an uptrend will come next. And same thing will happen with the bearish harami. Just inverse the colors and inverse the trend. Inverted hammer. An inverted hammer is formed at the end of the downtrend and gives a bullish reversal signal. The inverted hammer is the inverse of the hammer candlestick pattern. In this candlestick, the real body is located at the bottom and there is a long upper shadow. So this pattern is formed when the opening and closing price are near to each other and the upper shadow should be more than twice the real body. So if the inverted hammer appears at the end of a downtrend, then you will expect a reversal bullish. 3 outside up. The 3 outside up is a multiple candlestick pattern which forms after a downtrend, indicating a bullish reversal. So this pattern consists of 3 candlesticks. The first candle is a short red candle. The second candle is a long green candle which should cover the first candlestick. And the third one should be a long green candle, and all that confirm a bullish reversal and indicate that an uptrend is next. And note that the relationship between the first and the second candlestick should be of the bullish engulfing candlestick pattern. On-neck pattern. So, this on-neck pattern will appear after a downtrend, when a long red candlestick with no shadow is followed by a small green candlestick also with no shadow, which gaps down on the open but then closes near the period candlestick's close, or as we say, the same neckline. This means that the downtrend is nearing an end and next we will see an uptrend. So the chart will change direction. In this case, you will need to buy the crypto because we are expecting the price to go up. Dark cloud cover. So the dark cloud cover is two candles. The first one is a long green candle which indicates the continuation of an uptrend, and the second one is a long red candle which opens gap up but closes more than 50% of the rebody of the previous green candle. And this shows that the sellers are back in the market and a downtrend is going to happen soon. So what I usually do when I see this type of candlestick pattern appear after an uptrend, I usually short or sell and place a stop loss at the high of the second candlestick. Bearish engulfing. Bearish engulfing is the inverse of the bullish engulfing. It is a multiple candlestick pattern that is formed after an uptrend, indicating that a downtrend is coming. Same thing. Bearish engulfing is two candles. The second one engulfing the first candlestick, and the first one being a green candle indicating the continuation of the uptrend. So for me, if I see a bearish engulfing happening at the top of an uptrend, and after that I see the appearance of the red candle, the second red candle, I immediately sell, or if I'm trading future, I immediately short, and I place a stop loss at the top of the second candle. Three black crows. The three black crows is the inverse of the three white soldiers. If the three white soldiers are three green candlesticks appearing after a downtrend, here the three black crows are three long red candlesticks appearing after an uptrend. So for me, in my trading, if I see the three black crows appear and I'm sure that it's happening after an uptrend, I immediately sell, or if I'm trading future, I immediately short. Three inside down. The three inside down candlestick pattern is the inverse of the three outside up. So the shape of the three inside down is like this. Three candles. The first one is a long green candle. The second one is a small red candle which should be in the range of the first candlestick. And the third one is a long red candle confirming the bearish reversal, confirming the downtrend. The relationship of the first and second candlestick should be of the bearish harami candlestick pattern that we mentioned in previous episodes. And here, if you see this candlestick pattern, the three inside down candlestick pattern appear after an uptrend, you are expecting a downtrend to happen soon. So be prepared for the downtrend. You can sell or you can short. Bearish harami. The bearish harami is a multiple candlestick pattern which is formed after an uptrend indicating a bearish reversal. So it is the inverse of the bullish harami. It will appear at the top of an uptrend indicating a bearish reversal. It consists of two candlesticks. The first one is a tall green candle, and the second one is a small red candle, which should be in the range of the first candlestick. So the first green candle indicating the continuation of a bullish trend, and the second one shows that the buyers are back and the market will change direction and will go down. For me personally, I use it too much, bearish harami and bullish harami. It's helping me a lot predicting the trend and the movement and the direction of the market. But don't expect a lot. It's not the best indicator. It's not the best chart, and don't trust it too much because sometimes the market is unpredictable even after an appearance of a bearish or bullish harami. Bullish and bearish reversal. So the meaning of the bullish reversal indicates that the ongoing downtrend or the downtrend that is happening right now is going to reverse to an uptrend. So the direction of the chart and the market will change. So if it's going down, you will expect a rise in the price of the crypto. And this will create what we call a dip. And if you hear me say a bearish reversal in the next episodes, this only means that the uptrend that we see at the current moment will change into a downtrend, creating what we call a pump or sometimes a peak. Triple bottom. The triple bottom pattern is used in technical analysis as a predictor of a reverse position following a long downtrend. The triple bottom occurs when the price of the market creates three distinct downward movement at the same price before breaking out and reversing the trend. And the triple top is the inverse of that. If you see a triple top appearing after an uptrend, here you will expect a downtrend to happen and you can sell. In order to be profitable with option trading, you need to be able to predict the future of the market. If you somehow know the direction of the market the next 1 minute, this means that you will be profitable and nothing can stop you. If you've been following my trading sessions on my YouTube channel, you may be asking how I'm able to predict the colors of the candles for 10 minutes straight or sometimes up to 20 minutes straight. Believe me, there is no magic about it and you too can do it. I'm not saying that it's easy, but trust me, it's possible. And please remember that the sessions that I share with you on my YouTube channel are a simulation of what is possible to be done with binary option trading. I'm not guaranteeing you in any way that you will have the same results as I show you. I spent years and years in trading binary options. I mastered more than 50 indicators and more than 100 chart patterns. But if you have access to my private course, you already know that I have a special way to use some free indicators and some chart patterns. In this part of this free course, I will teach you how to use some free and useful indicators, and also I will share with you some good strategies. Trading with indicators. Indicators are used to help traders predict the movement of the market, the option market, the crypto market, or any market. So with the help of multiple indicators, you can predict the movement of the market, the forex market for example, and this means one thing: money. So predicting the exact price of any market with knowing what to do with this information can mean that you can make a lot of money no stop. So indicators are just mathematical tools that can assist you to predict the future price of a market or at least its direction with greater accuracy. So after a lot of technical mathematics, the data from the formulas are used to create a graph and then it's placed alongside or sometimes on the trading chart. And with good reading of the signals provided by those indicators, the trader can make profitable decisions. Moving average. The moving average is one of the indicators that I always use on my trades. It's useful for me to predict the movement of the market. So, what is a moving average? Moving average simply is a calculation to analyze data points by creating a series of averages of different subsets of the full data set. So traders and technical analysis like to believe that the trend on any market can be used as a guide. So for a market that is going up, it is more likely to keep going up, and a trend that is going down is more likely to keep going down. But if you take a look at any market or any crypto's graph, it's not that easy for you to define if this trend is an uptrend or a downtrend. And this is why we traders like to use moving averages to understand the market and place our trades without being afraid of losing. So there's two types of moving averages that I always use: the simple moving average and the exponential moving average. Simple moving average. Simple moving average, or the SMA, is a technical indicator or a tool that tracks the market's price over a time period and plots it on a line. And what this will do, so instead of seeing all the different ups and downs on the market, the SMA will help you see a clear trend, and it will smooth out the price fluctuations to give the trader or the investor a general idea where the trend is going. So the moving average will have a time frame. It can be an hour, a day, a week, or a month. So for example, let's define a day as our time period. And I like my simple moving average using the 20-day chart. So what the simple moving average would do for me is this: it will calculate the sum of the closing prices of the last 20 days and divide them by 20. And this value would be taken as a value of our SMA or our simple moving average of the current day. And we will do the same thing tomorrow, but to calculate the value of the moving average for tomorrow, we will have to drop the first day and add the value of the last day and divide it again by 20. So we will keep doing this, and we will have our moving average, and we will have a new value for our moving average every day. So the moving average, or the SMA, is an arithmetic moving average calculated by adding recent prices and then dividing that sum by the number of time periods in the calculation average. Exponential moving average. So the exponential moving average is an average price calculation just like the simple moving average, and also the calculation will be over a certain time period, which will apply more weight on the most current prices. So it will cause it to react faster to the most recent price change. And the AMA is one of the oldest trading indicators, and thousands of traders are using it today, especially day traders. the EMA will help them determine the trend, the direction, and the strength of the market. And personally, I even use it to identify entry and exit points. And to calculate the EMA, first we need to calculate the SMA, since this exponential moving average has to start somewhere. So the initial EMA value will be calculated from the simple moving average, and we will use it in the first calculation. And after that, we introduce the weighting multiplier for the number of periods we want to calculate our EMA. So we will have this equation. Our exponential moving average will be equal to the current price minus the EMA from the previous day multiplied by the multiplier, and we add to all that the EMA from the previous day. And remember that the number of periods will always impact the weighting multiplier. And once we determine the value of the simple moving average and the weighting multiplier values, the exponential moving average will be calculated like this. We will take our closing price and subtract from it the EMA from the previous day, all this multiplied by the multiplier, and lastly we add to it the EMA from the previous day. And finally, we will have this moving average that will smooth out our fluctuating market, but it will be affected by the recent changes in our assets price. MACD. MACD stands for Moving Average Convergence Divergence. And as its name implies, the MACD is all about the convergence and divergence of the two moving averages. So the convergence is when the two moving averages move towards each other, and the divergence occurs when the moving averages move away from each other. So the MACD uses two moving averages, a short moving average and a long moving average. The short-term moving average, or the moving average that uses the 12 days time period, is faster and responsible for most MACD movements. And the longer moving average, or the moving average that uses the 26-day time period, is slower and less reactive to price changes in the underlying market. So the next operation in creating the MACD is to create the MACD line. This line will be the result of a subtraction of the previous two moving averages from each other. And then this line will be used to calculate another EMA, or an exponential moving average, that is referred to as the signal line. And finally, we will use a histogram in our MACD. This histogram is generated based on the differences between the MACD line and the signal line. So the MACD indicator consists of three elements moving above and below the center line, or the zero line. And those three elements are the signal line, the MACD line, and the histogram. The MACD line is all about the momentum, so it will help you determine the upward or the downward momentum by measuring the gap between two exponential moving averages. And the second line is the signal line. Usually is a non-period exponential moving average of the MACD line. So in a daily chart, it is a 9-day EMA, an hourly chart is a 9-hour EMA, and so on. And about the MACD histogram, it is graphical representation that is calculated based on the differences between the signal line and the MACD line, but instead of adding a third moving line, the histogram is made of a bar graph, making it visually easier to read and interpret. Bollinger Bands. The Bollinger Bands is a type of an indicator that was created by a man called John Bollinger. And the idea of this indicator is to have two bands, which are envelopes plotted at a standard deviation level above and below a simple moving average of the price. And these two bands adjust to volatility swings in the underlying price because the distance of the bands is based on standard deviation. In the BB, there is two parameters which are customizable. The first one is the period, which is specially for the simple moving average. And the second one is the standard deviation. The default value for the standard deviation is usually 2, and the default value for the period is usually 20. With the Bollinger Bands, we can determine whether prices are higher or lower on a relative basis. You will always use them in pair, both the upper and the lower bands, and in conjunction with the moving average. Parabolic SAR. The parabolic SAR, or the parabolic stop and reverse, is a technical indicator that was created by Willis Wilder. The goal from the creation of the parabolic SAR was to create an indicator that will help you find a potential reversal in the market price direction. What the SAR is really is a trend following indicator, meaning this indicator will always follow the trend and sometimes will help you, not all the time. Personally, I don't use it all the time to determine entry or exit points, but in a lot of times it will help me figure out where to enter and exit a trade based on prices that was trending to stay within a parabolic curve during a strong trend. I hope that makes sense for you. So each trend in the market will have its own parabolic SAR and it will be calculated independently. So in the case of an uptrend, the SAR will be generated below the market price and will soon, if you pay attention, you will see it converge upward in the direction of the market. And similarly, in the case of a downtrend, the SAR emerges above the market price and will converge downwards. Alright, so the parabolic stop and reverse is always calculated one period in advance. So tomorrow's SAR value is built using the data available today and will be calculated using this formula. On the chart, the indicator appears as a series of dots, and these dots will be placed either above or below the price bars. So if you see a dot below the price, this means that there is a bullish signal. Conversely, if you see dots above the market's price, this illustrates that bears are in control and that the momentum is likely to remain downward. And usually, when the dots flip, meaning if the dots are above the market and all of a sudden a new dot appears below the market, this indicates that a potential change in price direction is underway. RSI. Developed by Willis Wilder and published in 1978, the RSI, or the Relative Strength Index, is a technical indicator used to help traders to measure the current or the historical strength or weakness of a market. And this will help you determine if the market is overbought or oversold. Usually, if the market is overbought, meaning that a downtrend is coming, and the inverse, if this market is oversold, this means that you need to be ready for an uptrend. So, to calculate the RSI first, we need to calculate what is called the relative strength. And the calculation of the relative strength is simply the average gain divided by the average loss. And the average gain is the amount of the gains that happened in a period, let's say, the last 10 days divided by 10. So this means if we gained $10, for example, in the last 10 days, we will divide it by 10, meaning we'll have an average of $1 every day. And same thing with average loss. So we calculate all the losses in the last 10 days, we divide it by 10, and we will have the average losses per day in the last 10 days. Alright, after we calculated our RS or relative strength, now we calculate our RSI with this simple mathematical equation. So we will have this technical indicator with the line oscillating between 0 and 100%.
I will be sharing with you one of the simplest yet very effective trading strategy that you can use to trade cryptocurrencies, stocks, forex, or any price actions without a need for a high-level technical analysis knowledge or a Wall Street trading level or the use of multiple trading indicators and chart patterns. Many beginning traders often get confused and overwhelmed with the sheer number of trading indicators and chart patterns available in the market. This can sometimes make trading seem like impossible for you to reach, causing traders to miss out on potential trading opportunities. And trust me, there's plenty of opportunities in trading cryptocurrency, forex, stocks, and many more. In this video, I will be sharing a trading strategy that uses only moving averages. It doesn't matter if you are a beginner or an experienced trader. This strategy can be used by both. This strategy is called the EMA crossover. I made this video for those who are not too much into trading. Now, let's jump to tradingview.com. Alright, now let me demonstrate to you on tradingview.com the EMA crossover strategy. With this strategy, we are going to use 3 moving averages, 2 exponential moving averages or EMAs, and 1 simple moving average. As you can see, our technical analysis will be done here on this platform, which is called tradingview.com. You can use this strategy on any platform that allow you to use indicators. First, we click on indicators. We write EMA, or you can write moving average exponential. We choose this one, moving average exponential. We click on it twice because we are going to use it twice. And then we write SMA, or you can write simple moving average or just moving average. We choose this one, moving average, and we close this window. Now, we are going to the first EMA, the first exponential moving average. All right. As you can see, the moving averages, the lines are applied to our chart. It's well calculated and ready to be used. So we go to the first exponential moving average, we click on settings, we change the color into white, and we choose a thicker line. We go to inputs, we change the length or the period of the exponential moving average into 100, and the source should be the closing price. The offset, we keep it at 0, and the smoothing method should be EMA. We click on OK, and we jump to the second exponential moving average or the second EMA. We click on settings. The length should be 50. The source should be the closing price, offset at 0, and the smoothing method also EMA. We click on OK again. For the second EMA, the color should be green, a little bit thicker line. Now we jump to the simple moving average. We click on settings again. We choose a red color. The thickness should be as thin as possible. Here the length should be 20. Source, also the closing price, offset at 0. The method should be SMA, simple moving average, and we click OK. So the EMA crossover strategy is like this. We wait for the 20 length simple moving average to cross both exponential moving averages, the 50 period exponential moving average and the 100 period exponential moving averages. When we see the red line crossing both lines from below to above, this indicates that we should expect an uptrend, meaning somewhere after the crossover we should open a long position or we should buy. So the first rule is simple. We wait for the red line or the 20 period simple moving average to cross both exponential moving averages from below to above. This will indicate that we should see an uptrend after this crossover. All right. The second rule is like this. We are going to use this 100 period exponential moving average as a dynamic resistance and support lines. Like in this case, it's taking a place for a resistance line. So the second rule is like this. Once the market crossed the resistance line, this indicates that now the buyers are taking the lead and we should open a long position. So both rules are indicating that we are seeing an uptrend, and as you can see after that, the market created this clear bullish trend. And yeah, the breakout, the SMA crossing the EMAs, all the rules are here and we should open a long position. So I want to make it clear that the 100 period EMA, this one is playing a role of a resistance line and then a support line. So it's a dynamic resistance support levels. When the market breaks out the resistance line, we expect a continuation of the bullish trend. And the opposite, if the market breaks the support line, we expect a continuation of a bearish trend. All right, let's take another example. So here there is a crossover, the 20 period simple moving average. The red line is crossing both exponential moving averages, both EMAs. It's crossing it from above to below. As you can see, this one, the green one, is the 50 period EMA and the white line is the 100 period EMA. And sometimes we even use the 200 period EMA to determine the direction of the market. But in this case, we use the 100 period EMA, it will give us great result. As you can see, the market is breaking the support line. The market is crossing the 100 period EMA from above to below, indicating that a downtrend will take place. And as you can see, immediately after the two rules are applied, the first one, which is the 20 period SMA, is crossing both EMAs from above to below. The second rule, the market is crossing the 100 period EMA. All this indicate that we should see a downtrend, and really a downtrend took place. And if we open the short position here, we would make some profit. All right, let's look for another example. Here, for example, so as you can see, the two rules are applied. The first rule, the 20 period simple moving average or the 20 period SMA is crossing both lines. The first one, which is the 50 period EMA, this one, the green one, and it's also crossing the 100 period EMA, the white line, from below to above, and then the market is breaking the resistance line. So the market is breaking the 100 period EMA from below also to above. All this indicate that we should see an uptrend, and as you can see, immediately after that, the market created a clear uptrend. So if you use this strategy and you opened a long position or you bought, so buy here, as you can see, we can make up to 8% profit. All right, let's take another example. Immediately before the last signal, we had this signal also. So as you can see, the SMA, the 20 period SMA, simple moving average, is crossing both EMAs, the 50 period exponential moving average and the 100 period EMA, crossing it from below to above, and then the market broke the 100 period EMA that was playing a role of a resistance line. This indicates that we should see an uptrend, and as you can see, the market really created a clear uptrend, and if we opened a long position here, we could make up to 30% profit. Amazing. Let's take another example. So here, as you can see, this one is perfect and clear. So the 20 period simple moving average or the 20 SMA, it crossing the first line, the 50 period EMA, and then crossing the 100 period EMA from above to below. And then the market, as you can see, broke the support line, which became the resistance line here. All this indicate that we should see a downtrend, and really immediately after that, as you can see, the market created this clear long downtrend. So that's all you need with this strategy, simple. So as you can see, we could open a short position here and make profit from all this clear downtrend. So that's it, guys. This is the EMA crossover strategy, a strategy that uses only two exponential moving averages or EMAs and one simple moving average, the 100 period EMA, the 50 period EMA, and the 20 period SMA. What if I told you that with two indicators, you can generate signals with more than 80% winning rate? Yeah, 80% winning rate. The strategy that I'm going to explain to you in this video is called all-max strategy and is using nothing but two of the most famous indicators in the market. The first one is MACD, and the second one is the exponential moving average. Yeah, there's plenty good indicators out there that you can use to generate good signals, but my advice to you is to use as minimum indicators as possible to avoid confusion. Me personally, I use 5 indicators at max, and the most important thing is the strategy that you use. I use my own strategy, and by the way, the strategy that I spent more than 7 years in developing is explained in chapter 4 in the course in the description below. In this course that I spent more than 3 years in making, I explain everything I learned over the years, from the indicators that I use, the strategies, the chart patterns, the money management methods, and many more. So if you are interested in learning cryptocurrency trading from me personally, I invite you to go to the link in the description below and enroll now. All right. All max strategy is based mainly on MACD. And for those who don't know what MACD is, let me give you a brief introduction. MACD stands for Moving Average Convergence Divergence. And as its name implies, the MACD is all about the convergence and divergence of the two moving averages. So the convergence is when the two moving averages move towards each other, and the divergence occurs when the moving averages move away from each other. So the MACD uses two moving averages, a short moving average and a long moving average. The short-term moving average, or the moving average that uses the 12 days time period, is faster and responsible for most MACD movements. And the longer moving average, or the moving average that uses the 26-day time period, is slower and less reactive to price changes in the underlying market. So the next operation in creating the MACD is to create the MACD line. This line will be the result of a subtraction of the previous two moving averages from each other.
And then this line will be used to calculate another EMA, or an exponential moving average, that is referred to as the signal line. And finally, we will use a histogram in our MACD. This histogram is generated based on the differences between the MACD line and the signal line. So the MACD indicator consists of three elements moving above and below the center line, or the zero line. And those three elements are the signal line, the MACD line, and the histogram. The MACD line is all about the momentum, so it will help you determine the upward or the downward momentum by measuring the gap between two exponential moving averages. And the second line is the signal line. Usually is a non-period exponential moving average of the MACD line. So in a daily chart, it is a 9-day EMA. In hourly chart is a 9-hour EMA, and so on. And about the MACD histogram, it is graphical representation that is calculated based on the differences between the signal line and the MACD line, but instead of adding a third moving line, the histogram is made of a bar graph, making it visually easier to read and interpret.
Now, let's jump to Trading View. Click here on Indicators, look for MACD or Moving Average Convergence Divergence. Choose this one, and let's jump to Parameters, and let's set up the indicator. The values used with this indicator in the all-max strategy is different from the default parameters. Here, for the fast EMA, we are going to use the length of 10. For the slow EMA, we are going to use the length of 30. And the source should be the closing value. And we click OK. The first rule to use this strategy is like this. We wait for the MACD line, or the blue line in this case, to cross the signal line or the orange line. The second rule, if it's crossing it from below to above, this means that this is the best moment to buy. And if the MACD is crossing the signal line from above to below, this means that we are expecting a downtrend and we should short. The third rule, as you can see here, this is the zero line. We will only short when the two lines are above the zero line, and we will only long when the two lines are below the zero line. Now, let's take an example. Here, as you can see, the MACD line is crossing the signal line from above to below. They both are above the zero line, meaning this is the perfect moment to short. If we look at the market, here, a perfect bearish trend took place. So, this signal was right. Let's take another example. Here, the MACD line is crossing the signal line from below to above, and they are both under the zero line, meaning this is the perfect moment to long or to buy. And as you can see, immediately after that, a long bullish trend took place. And here, if we opened a long position or we bought here, we could make a lot of money. But wait a minute. We still have another indicator to introduce to this strategy. And this strategy can be used on cryptocurrency trading, stock trading, forex trading, and many more. And as you already know, no indicator in the world will give you 100% winning rate trading signals. What we are trying to do with our strategy is to make it as perfect as possible. Meaning, if you have a strategy with more than 80% winning rate, this means money. 80% is really a lot. But if you are planning to depend on this indicator alone, trust me, you are going to face a lot of false signals. For example, here, all the rules are applied. The MACD line is crossing the signal line from above to below. They are both above the zero line, but as you can see, the market took the other direction. Also here, as you can see, the MACD line crossed the signal line from below to above. They are both under the zero line. This is indicating that we are going to see an uptrend, but the market took the other direction and went all the way down. And to avoid cases like this, we are going to introduce another indicator, the EMA, the exponential moving average.
So the exponential moving average is an average price calculation, just like the simple moving average, and also the calculation will be over a certain time period, which will apply more weight on the most current prices. So it will cause it to react faster to the most recent price change. And yeah, the EMA is one of the oldest trading indicators, and thousands of traders are using it today, especially day traders. The EMA will help them determine the trend, the direction, and the strength of the market. And personally, I even use it to identify entry and exit points. And to calculate the EMA, first we need to calculate the SMA, since this exponential moving average has to start somewhere. So the initial EMA value will be calculated from the simple moving average, and we will use it in the first calculation. And after that, we introduce the weighting multiplier for the number of periods we want to calculate our EMA. So we will have this equation. Our exponential moving average will be equal to the current price minus the EMA from the previous day multiplied by the multiplier, and we add to all that the EMA from the previous day. And remember that the number of periods will always impact the weighting multiplier. And once we determine the value of the simple moving average and the weighting multiplier values, the exponential moving average will be calculated like this. We will take our closing price and subtract from it the EMA from the previous day, all this multiplied by the multiplier, and lastly we add to it the EMA from the previous day. And finally we will have this moving average that will smooth out our fluctuating market, but it will be affected by the recent changes in our assets price.
Now, let's jump back to tradingview.com. We go to indicators, we look for EMA or moving average exponential. We choose this one. The length of the EMA must be 100 with the closing price. We click OK. Now, the fourth rule here is we will only long when the market is above the EMA, and we will only short when the market is below the EMA. So the exponential moving average here is helping us to determine the trend of the market and will help us to avoid to trade against the market. So for example here, as you can see, all the rules are applied. The first rule, the MACD line is crossing the signal line. The second rule, it's crossing it from below to above. The third rule, both lines are below the zero line. And the fourth rule, the market is above the exponential moving average. All the rules are indicating that we are going to see an uptrend. And really, this is what happened. The market created a clear bullish trend. Let's take another example. Here also, all the rules are applied. The first rule, there is a cross. The second rule, the MACD line is crossing the signal line from above to below. The third rule, both lines are above the zero line. The fourth rule, the market is below the 100 length exponential moving average. All this is indicating that we will see a downtrend. And really, immediately after that, we can see this downtrend. If we continue looking for signals, this is always happening. If you are planning to use this strategy a lot, I advise you to add to this strategy RSI or Bollinger Bands. With these 4 indicators, you can really generate great signals. Now, I'm giving to you the signals for free. The only way that you can pay me back is by liking the video and subscribing to the channel. And I want you to remember that I'm not a financial advisor in any way. I'm making these videos for entertainment purposes only.